Hey everyone, welcome back to Stock Predictor, the place where we break down complex investing ideas and turn them into clear, actionable insights you can actually use. Today we're diving into a question I get asked all the time. When it comes to passive income, who wins, dividend stocks or royalty trusts? If you've ever wondered which one pays more, which one is safer, or which one makes sense for your portfolio, this video is going to give you everything you need. We're going deep: how they work, how they pay, the risks, the tax situations, the long-term performance patterns, and ultimately which one might be the better passive income generator for you. So stick around until the end, because the winner may not be the one you expect. Before we jump in, hit that like button if you love building passive income streams, and subscribe to Stock Predictor for more smart investing breakdowns. Alright, let's get into it. So let's start by understanding what each of these actually is, because the structure behind the income source matters just as much as the payout itself. Dividend-paying stocks are exactly what they sound like: companies that share a portion of their profits with investors. These might be big, stable companies like Coca-Cola, Johnson & Johnson, Procter & Gamble, Verizon, or utilities, banks, industrials, and even REITs. The point is, dividends are tied to the company's ability to generate profits and maintain long-term stability. On the other hand, royalty trusts are a totally different animal. These are legal structures, often tied to oil, natural gas, or mineral rights, that collect revenue from wells, mines, or land and pass that income directly to shareholders. Royalty trusts typically don't have employees, don't operate businesses, and don't expand. Their entire purpose is to take the income from existing wells or reserves and distribute it to unit holders. That means they can pay extremely high yields, sometimes 8%, 10%, 15%, or even more, depending on commodity prices. Now when people see those big yields, they immediately think royalty trusts must be the obvious winner for passive income. But the high yield is only part of the story. What matters is whether that yield is stable, sustainable, and actually long-term. And that's where things get interesting. Dividend stocks have a big advantage when it comes to consistency. These companies aim to grow over time. They develop new products, expand into new markets, buy back shares, acquire other companies, and reinvest their profits. That means dividends are usually supported by long-term business growth. And some companies have been raising dividends for decades. I'm talking 10-year, 25-year, even 50-year dividend growth streaks. That tells you not only that they pay, but that they intend to pay and continue paying as part of their identity. Royalty trusts, however, don't operate like that. They're more like melting ice cubes. They receive income from natural resources, but those wells eventually dry up, and the reserves eventually shrink. That means the income from a trust generally declines over time unless commodity prices rise enough to offset that decline. Some trusts even have defined end dates. The moment the reserves hit a low threshold, the trust dissolves and investors stop receiving income forever. That's not exactly a long-term passive income machine. But royalty trusts have something dividend stocks can't match: exposure to commodity price spikes. If oil prices suddenly surge, the income from a royalty trust can explode upward, meaning your yield could temporarily double or triple. That's the kind of explosive cash flow dividend stocks rarely provide. So the question becomes, what kind of passive income do you want? Smooth and predictable, or high risk, high reward, boom and bust income? Let's talk about stability for a second, because this is where dividend stocks shine. Companies like Johnson & Johnson or Procter & Gamble have survived wars, recessions, inflation cycles, supply chain disruptions, political turbulence, you name it. Their businesses are built to last, and so are their dividends. Many investors build entire retirement plans around dividend payout streams from these kinds of companies because of their predictability. Royalty trusts, on the other hand, rise and fall with commodity markets. Oil and gas can be extremely volatile. One year a trust may yield 12%, the next year 6%, then the next year maybe 18%. It's unpredictable, and unless you're comfortable with that roller coaster, you probably won't enjoy holding trusts long-term. Now let's talk taxes, because passive income isn't just about how much you collect, it's also about how much you get to keep. Dividend stocks generally pay qualified dividends, which are taxed at lower long-term capital gains rates in the US. That means your dividends can be much more tax efficient, especially if you're in a higher income bracket. And if you hold dividend stocks in retirement accounts like a Roth IRA, you may not pay taxes at all on those dividends. Royalty trusts are more complicated. Their payouts are often considered royalty income or depletion income, and investors usually receive a tax form called a 1099 MISC instead of a 1099 DIV. This income can be taxed at ordinary income rates unless certain depletion deductions apply. Plus, the tax paperwork itself is more complex. Some investors don't mind, but others prefer simplicity, and dividend stocks definitely win there. Let's move to longevity. Dividend stocks can theoretically pay dividends forever as long as the company stays in business. Many investors hold dividend stocks for 20, 30, even 40 years. Royalty trusts don't have that kind of lifespan. The income will eventually decline as the underlying resources are depleted. Some royalty trusts are already paying only a fraction of what they did 10 years ago. Others have dissolved completely. So where do royalty trusts shine? Yield. Pure, raw yield. If your goal is maximizing short-term cash flow, royalty trusts can deliver incredibly high payouts. That's why some investors use them as opportunistic plays, buying low when commodity prices are weak and collecting large payouts when the market tightens. But this requires timing, research, and risk tolerance. Dividend stocks, meanwhile, are more about sustainable cash flow. Companies like Coca-Cola or McDonald's might only yield 2.5% or 3% today, but they grow their dividends every year. Over time, your yield on cost can climb dramatically. A stock yielding 3% today could yield 8% on your original investment a decade later, and maybe 15% after 2 decades. That's something royalty trusts simply can't match because they don't grow. Let's talk about which one builds long-term wealth more effectively. Dividend stocks reinvest profits into the business, which can increase the stock price over time. That means you get both income and capital appreciation. It's like getting interest on your interest. Royalty trusts don't reinvest anything. They simply collect resource income and distribute it. The share price usually declines slowly over time as the trust depletes. So you might collect high income today but see your initial investment erode in the long run. Some investors don't mind this trade-off because they view royalty trusts as temporary income vehicles, not forever holds. But if you're building a retirement portfolio or generational wealth, dividend stocks clearly have the advantage. Now let's imagine 2 investors. The first one buys solid dividend stocks and holds them for 20 years. Over time, the dividends grow, the stock price grows, and they end up with a big, steady stream of income. The second investor buys a royalty trust paying a high yield. They collect large income early on, but the trust declines in value and eventually dissolves. Their early income may be higher, but it doesn't last. So it depends. Do you want maximum cash flow right now, or lower but growing income that could last a lifetime? We also need to talk about economic environments. Dividend stocks perform well when the economy is stable or growing. Royalty trusts perform best when commodities spike, usually during inflation, geopolitical conflicts, supply shortages, or economic uncertainty. So sometimes trusts outperform dramatically, but those moments aren't predictable. If you're investing purely for income stability, dividend stocks are easier to rely on. So who wins? Dividend stocks or royalty trusts? The answer truly depends on your goals. If you want stable, predictable, long-term passive income that can grow over time and build generational wealth, dividend stocks are the clear winner. They offer dividend growth, capital appreciation, stability, tax efficiency, and longevity. If you want short-term, high-yield cash flow and you're okay with volatility, declining long-term value, and more complicated taxes, royalty trusts can give you massive payouts, especially during commodity booms. For most long-term passive income investors, dividend stocks are the better foundation. They're reliable, they grow, and they last. Royalty trusts, however, can be powerful supplements, kind of like bonus income during strong commodity cycles. So here's the real takeaway. Dividend stocks are the backbone of a sustainable passive income strategy. Royalty trusts are the high-octane boost you might use strategically but shouldn't rely on forever. Think of dividend stocks as your long-term rental property, and royalty trusts as a short-term cash-generating opportunity. Both have their place, but they serve different purposes. Let me know in the comments which one you prefer, steady dividend income or high-yield royalty trusts. And if you want me to break down the best dividend sectors or review the top-paying royalty trusts, drop a comment and I'll make it happen. If you found this video helpful, smash that like button, subscribe to Stock Predictor for more investing insights, and hit the notifications so you never miss a new upload. Thanks for watching, and I'll see you in the next one.